There's a relatively famous investor in India who passed away recently. You may have seen the news even in Thailand, Rakesh Jhunjhunwala. And Rakesh was a billionaire several times over. He never managed money for others. He only really managed money for himself. And he actually started with nothing. He actually borrowed about $20,000 at about 18% interest from some individuals to get going. When he passed away recently, he had a few $1 billion to his name. And Rakesh was he was kind of a split brain in the sense that he did a lot of day trading and rapid fire in and out trading. But at the same time, he had some positions that he held for decades, never touched them. So, for example, he had made an investment maybe about 25 or 30 years ago into a company in India called Titan. They actually are a jewelry retailer. They used to be a watch retailer, but now jewelry manufacturer and retailer. He had put about, like I said, about 3 decades ago, about 4% of his net worth into Titan, and he never really touched it after that. He also said in one of the interviews that he actually never visited a single manufacturing plant of Titan over that period. I think it represented about close to half of his net worth when he passed away. So, something that was a 4% investment became 50% or more of his portfolio, and the rest of his portfolio had also done well. So this was quite a significant return. There was another company, a pharmaceutical company, Lupin, which he'd also held for a very long time. And there was a third one that he very deeply regretted till the end that he sold. So he had made a few times his money on that. That was CRISIL. It was a credit rating agency, the best credit rating agency in India. So the thing is that I think the holy grail of investing that I have figured out so far is to have partial ownership of businesses that can grow and compound for very long periods of time, where the business has qualities which allow it to increase intrinsic value over a period of time. And usually these companies have some attribute that allow us to maybe identify them. One of the attributes that they tend to have, they tend to be run by or founded by kind of fanatical leaders, maverick leaders who don't really fit the normal mold. They kind of appear somewhat unusual in their makeup. So, like for example, in the United States, we have an airline called Southwest Airlines. Southwest Airlines has done extremely well. I mean, it's been around for 50 years, and I don't think they've except perhaps during COVID, they never lost money any year. And they actually pioneered the low-cost carrier movement around the world. A lot of companies around the world, Ryanair and Asia Air and so on, they all copied Southwest model, which Herb Kelleher came up with. What Southwest was trying to do is they were not trying to compete with other airlines. They were a short-haul carrier. And Herb Kelleher said that I'm trying to compete with the driver trying to drive in his car to between two cities, 200 or 300 miles. And he said, I want to make flying cheaper than the person putting gas in his car and going, one tank of gas to get to another city. And so he focused all the cost structures of Southwest to make it attractive for that particular type of customer, to find Southwest attractive. And when he was able to make that attractive for that type of customer, other airlines just couldn't compete with him. Their cost structures were designed to compete with other airlines, not with people driving cars. And so Southwest got a kind of sustainable advantage. And, for a very long period of time, they compounded at a higher rate than Berkshire Hathaway from the 70s on from there. One of the ways, so, these multibaggers, companies that go up 50 times, 100 times, 1,000 times in value, they can come in different stripes and colors, but they do have some commonality and they do have some common frameworks that can help us identify. One of the frameworks that is actually easy to screen for and easy to look for what I would call Uber cannibals. So these are companies that are very aggressive about buying back their shares. Typically, these companies issue no dividends and they are pretty much plowing back sometimes more than 100% of cash flows or close to 100% of cash flows into buybacks. And there is something very unusual and magical and actually non-linear that happens when you do buybacks kind of pace over a few decades. So for example, we have a home builder in the United States in the East Coast called NVR. NVR basically for the last 28 years has plowed back almost 100% of their cash flows into buybacks. They don't issue dividends, they only do buybacks. The one thing they changed in their business model about 3 decades ago is most home builders, what they would do in the United States is they will have a lot of investment in land. They buy land banks and then they develop the homes and then they get rid of the land and they keep buying more land. What NVR did is they changed that approach to being just in time. They basically went to landowners and got options, bought options to buy their land. So if a piece of property would cost 10 million or $30 million, they might put up, two or 300,000 or $500,000 to have the option to buy that land at a fixed price over some period of time. And that way they don't have capital tied up. Then when they need the land, they exercise that option. So once they go to land not being a factor of production that they need to invest in years in advance, it becomes a very capital light business. And it becomes a business that generates very high returns on equity. And home building is a cyclical business. It goes through ebbs and flows. But because they don't have a lot of fixed costs in their model, and because they don't have a lot of capital in their model, all they do is like when they hit an air pocket, like, demand is low and sales are low, they'll stop the buybacks. They won't have earnings, so they'll stop the buybacks. And from 94 till now, that only happened 2 years during the financial crisis, 2008 and 2009, when housing demand went down a lot in the US. So NVR basically has bought back 75% of the shares outstanding in the last 28 years. They used to have about 16 million shares outstanding. And I think now it's about like 3.5 million. And the shares used to be, and they don't split the stock. So actually it's really easy to look at their returns. 28 years ago, the stock was $6 a share. And it's gone down a little bit in 2022, but at the end of 21, it was about $6,000 a share. So it went from $6 to $6,000 over a 28-year period. It wasn't a 100-bagger. It was a 1,000-bagger over a 28-year period. It wasn't a company designing software or something which you would normally think of as a high return on equity business. They're just building homes. And basically all their incentives and everything to management is around the return on equity and all of that. So it's all very focused in that area. There's another company called AutoZone, which is a auto parts retailer in the US. And AutoZone, again, has over the last 3 decades had a similar story to NVR, where they basically have no dividend. And in their case, they're growing, they've been adding more stores. But again, it's a high return on equity business. There isn't much equity in the business. Its stock has gone up about 200 times in the last. So basically, when companies do buybacks, buying back 3%, 5% of the shares, that doesn't do a whole lot. But if they do it for 20 years in a row, and that share count goes down 80%, now it starts getting interesting, because in the case of NVR, for example, in the last 28 years, the revenues went up 10 times. Okay, so the stock went up 1,000 times. The revenue only went up 10 times. And if you look at inflation over this 28-year period, adjusted for inflation, it may be much less than that. So they didn't have extraordinary growth in terms of the top line. What they did have was the market recognizing that this is a compounder, and the market took the multiple really high. Stock trades like 40, 50 times earnings, and maybe 20, 30 years ago, just be, single digit multiples and so on. So they got a pop because of the consistency, and then so on. So one can screen for these types of businesses relatively easily, right? Because you can look at share counts and you can see whether, and once you see that a company doesn't issue dividends and the company is consistently buying back shares, and the most important thing is the business model needs to be sustainable and enduring. So we can look at the business, and it is not that difficult to tell what is a great business, what is a good business. That's not really difficult. It's more difficult to tell what is a good investment, but to actually tell what is a good in business is not very difficult, because what you're looking for is, does the business generate above average returns on equity without using much leverage? Is it able to grow? Does it have some enduring competitive advantage over its competitors? And what is the secret sauce that makes it keep going year in and year out? So if you study a business like NVR, or you study a business like AutoZone, it would take some time, but you would be able to figure out what is the enduring advantage these businesses have. When you screen for these types of businesses and then drill down on the ones that have this type of a fanatical approach, there's very few of them that have this type of fanatical approach, right? Because most managements, generally speaking, are not great capital allocators. They don't understand capital allocation really well. And buybacks are kind of weird from a management perspective. They kind of look like cash leaves your door and you don't really see anything happen when the cash leaves your door, but it happens over a period of time. So I think that the multi-baggers can come in many shapes and sizes. One of them that is an important one to look at is the ones that have understood the importance and power of buybacks. And once they understand that, and if the business model is very stable, then it can be a tremendous advantage. I was speaking to Abub just before we started our recording, and he brought up that I've mentioned in some previous talks a company in Turkey called Resas Logistics. And Resas has never bought back any shares, right? And this was a business which I invested in 2019. And at that time, the market cap was like around $20 million. And the intrinsic value was probably, liquidation value was probably 700 or 800 million. Intrinsic value was probably over $1 billion. I told the management of Resas that, look, it's almost impossible. You guys are really good capital allocators. You have a very good nose for how you do deals. It's almost impossible that you can find anything to do which would be superior to buying back your shares, because you're buying back at like 3% of liquidation value. The accretion to that. But, whatever I said to them made no sense, because they've never thought about it in those terms. What they have understood now, which took them again a couple of years to understand, is that they should buy back more. They should buy more shares for themselves. And so they've been doing that, which is good, which is pretty good for them to do that. But, maybe after a few years and some more trust, maybe 5 years or something, we may, because that business has the qualities that we look for. They are leasing warehouses, and they're like the number one warehousing company in the country. 99% leased, 10-year inflation index leases, cash flows are very stable. Cash flows are more stable than NVR or AutoZone. It's a very predictable recurring revenue business, which neither NVR or AutoZone are. And so when you get those type of characteristics where a business is operating like clipping coupons on a bond and the stock is really cheap, you can get incredible results. But it takes time. It takes time to build trust and convince management and so on. And we'll do well even if they never do any of that. It's just that we would do exceptionally well if they did something. So that would be fine. So I think that, multi-baggers can come in number of shapes and sizes. The most obvious ones can be technology business, right? So now the issue with technology businesses is that, like Buffett says, industries with rapid change are the enemy of the investor. So we would need to find tech businesses which have kind of got attributes like, for example, a Microsoft, which has a very strong install base of cloud-based applications and such and software, which people cannot do without and people cannot change easily and such. And we would need to find those businesses at reasonable valuations. So usually the problem we get into with these great software companies is everyone knows they're great and the prices reflect the greatness. But sometimes you can get aberrations. You can get, like, one of the things that happens is that when a packaged software company is switching to the cloud, so the revenue is going from licenses being sold to a recurring subscription-based model, the revenue will take a dip initially because as they're transitioning, if Microsoft sold Microsoft Office as a package, they would collect like $500 or $400 one shot for one user. When they do it through a cloud-based offering, they get like, $8 or $10 a month. And so near term, your revenue will drop, but long term, you do a lot better because people may not, after 4 years, buy another package for you. They may run the same Word software for 10 years without upgrade, for example. So sometimes you can get a mispricing because the market doesn't appreciate this particular nuance of, the earnings taking a dip temporarily and such, and it's not being normalized earnings and so on. So you can get great compounders from the classic, very stable recurring revenue software businesses or cloud-based businesses and so on. That can be a valid way to go. You can also get it from companies that are really, really good at what they do. Like Costco in the United States would be an example. Walmart might be an example. So these are companies in really difficult spaces. Retail is a really, really difficult space to be in. But sometimes you get some businesses that are really great at it, and they've proven they can endure for a long time. Then it can work out very well. One other thing about these multi-bagger compounders, if we go back to the example of Rakesh Jhunjhunwala, is, like I said, he put 4% of his portfolio, which later became 50%. I think Titan compounded at more than 30% a year for a long time. And it has a great model. It'll keep going. I mean, I think that runway is really long. It tolerates a very high error rate because let's take an example that the other 96% of Rakesh's portfolio went to zero. If that had happened, he would still have a major home run. So if we make these compounder bets, and let's say we put 10% of portfolio into each bet, and we study these businesses carefully, and we make 10 of these bets like NVR, AutoZone, and whatever. The most important thing, which is the most difficult for investors, is after that, you need to go to sleep. So after making the bet, because nothing will go in a straight line, there will be news coming out all the time. There's invasions into Ukraine, and there's the inflation in the US, and the Fed is raising rates, and the business might take a hiccup here and there or whatever else. So there's 100 different reasons for which one might be tempted to take action. And to Rakesh's credit, considering that he had like 4 screens in front of him all day long, he never touched the Titan position for several decades, died with it. So the important thing in investing is not how smart you are. This is not a game of like the highest IQ person wins, because it's not that difficult to figure out. If you gave me, or if I gave you a list of 100, the top 100 market cap companies in Thailand, and I just ask you to rank them in terms of quality of business, forget the valuation, forget everything, just quality of business. And I asked, 50 students to do that. Their list wouldn't be that different. What companies show up in the top 10 might be very similar. Top 20 might be very similar. Bottom 20% might be very similar, and so on. So the identification of a great business is not that difficult. What is the most difficult is not doing anything after you find yourself in the fortunate position of ownership of these businesses. So taking Rakesh's example, if you made 10 bets and you just said, okay, no matter what the news is, I'm just going to ignore everything. And in some cases, the news dictates that you should actually sell. The business has gone into secular decline, for example, and you can tell it's going. But let's say you take no action. You live with the secular declines, see some of them go to zero, all of that. It would still be an exceptional run at the end of 20 or 30 years. And the reason why most investors don't enjoy those great returns is because they get in their own way. They are not content with watching paint dry. If you are the kind of person where, some painter has painted some wall white color, and you can just sit there for 8 or 10 hours and watch it dry and be really happy, then this is the business for you. French mathematician Pascal, so one of his famous quotes is that all man's miseries stem from his inability to sit quietly in a room and do nothing. I would just paraphrase Pascal to say all investment manager miseries stem from their inability to sit quietly in a room and do nothing. And so one of the things I try to do is I try to do a lot of sessions with students like you, because it absorbs the time. If I have too much time to, worry about the portfolio or think about things, it might cause action. Buffett plays about 10 or 15 hours a week of bridge. And I play about 10 or 15 hours a week of bridge. Bridge is almost as good an activity for me as investing. I think investing still gets a little bit of an edge for me, but bridge is a tremendous activity for me. I enjoy it a lot. If you put me in a prison cell for the rest of my life with 3 other bridge players and, the same food being served for every meal, I would be extremely happy for the rest of my life. That would be a very blissful existence. Bridge is a very healthy pursuit for investors. And so I think that investing is a great activity for gentlemen or ladies of leisure, gentlemen of leisure, or ladies of leisure, where basically, if you can be really content to not take any actions on your portfolio, you will do really well. And one of the reasons the index is so hard to beat is the index is too dumb to know that it owns Microsoft. And it's too dumb to know that it owns Alphabet. And it's too dumb to know that it owns AutoZone. And it's too dumb to sell any of them. And so what happens with the index is that every once in a while, the people who run these indices make some change, right? Like they'll take GE out of the Dow Jones, take IBM out of the Dow Jones. Usually the changes they're making are made such a long time after these absolute loser companies have proven that they're losers. But they'll never take a Tesla or a Microsoft or an Alphabet, which is cranking and climbing out of the index. That will not happen, right? So they usually take out the companies where they see a decline in sales, losses for many years, the business has lost its way, and so on. And so that's the reason why the index is so hard to beat, because the index is really good at watching paint dry. It just cranks with doing nothing. And that's really what you want. And the only way to get better than the index, because the index also owns a lot of losers. But like we saw with the Rakesh Jhunjhunwala example, a 4% position becomes 50% because he just doesn't touch it. And so what ends up happening with the index is Apple starts off being really small and Apple becomes a really large position. And Microsoft starts off really small and it becomes a large position. And so when you look at the index after 20 or 30 years, you find like 7 or 8 companies that are like make up 30, 40% of the index and such. So that's why indexing is really good for almost all market participants. Most market participants will do better by focusing on the index.